356, Evaluating Business Opportunities. I know a few of you had those when you were in school. 356 is a class that allows students to evaluate an idea, do primary market research, which is what I'm talking about, assess whether or not they want to develop a plan, and develop a business plan, and actually do a pitch at the end of the spring quarter. So Dennis has a lot of experience guiding many, many teams through this process. So Dennis is going to go through the business plan as a very valuable exercise to go through in preparation for the pitch. So, Dennis, thank you.
Thank you, Linda. I had an opportunity to look through your backgrounds, and I'd like to get a sense from the class about how many of you plan to launch a venture in the next year or two. Well, that's great. What I'd like to go through today is basically how to structure a plan. And you may use the plan for many purposes, but I'd like to get a sense from the class. This is not a minor exercise to put together the plan, and what might be some of the reasons you do that? Why would you go through this exercise? Yes, Leela?
I think it's a great planning tool.
Yeah.
As you're going,
You clarify what you're thinking about. So there's clarify what you're doing. What else might you do? Pete?
Helps you anticipate some of the challenges you
What,
have.
yeah, some of your challenges. What else? Yes, Jim.
I'd say validation. I mean, to really go through it and really ask the hard questions of yourself. If you can't convince yourself, it's going to be tough.
So validate it for yourself and for your team. Validate. What are some other reasons to go through this? You really, this is the first time if you're putting together a team, this is one of your first exercises to exercise a team. Laura?
If it's about what I was going to say, is alignment with your co-founders of your team.
Yeah.
Really all kind of things.
Yeah, and a big question you should be asking is, how do you measure success? You know, kind of different meanings for different. So there really kind of be three elements you'll be working with. One is a pitch, an oral pitch. And then getting a real, and I'll give you slides on all this, so you can just, I've got slides. Then there's an oral presentation that's around that pitch, but you'll also need to write a really succinct 1 or 2 page executive summary. And normally the way it works is you've got an idea of who the audience is, and the first thing they'll say, send me an executive summary. And if you don't get through the executive summary, you probably don't have the meeting. So you need that and the oral presentation. And then when you're there, you probably go through your pitch, and they may or may not ask for a final written plan, which really documents a lot of the work you've done up to that point. So we'll see how this works. So you really have to understand, really to define your business, understand where you have gaps. What are some real problem areas? To gain ownership not only yourself, but other team members. And it's your game plan for your launch. The use of this. It might be for raising funds. It might be to attract a really key partner. It might be, gee, we really need this one employee, and they'll say, tell me about your business, and here's your plan. So you've got various different uses. You might need to partner with someone. Gee, if we can really get this one partner outside, we could be successful. So the plan has to be oriented towards who's the audience. And as you look at your opportunities here, I think you have various different audiences. And this is really... So one class is your investors. But it might be to recruit an executive team. It might be we could really be successful if we had the following board members. Or we could really be successful if we made this one deal with this one company that could be our great distributor. So you have to think about who is your audience. And you have a different pitch, really, depending upon who your audience is. What I'll focus on more is the investor side for this. But just think, maybe the real issue is, and I've had cases, I've my own background, I've actually started successfully 7 companies. And I've gone the whole range from the real issue is I needed to raise capital to another issue, I really needed to attract in these key people. And there's a different kind of pitch across those two perspectives. And let's take the investor audience. So the investors could be everyone from friends and family to angel investors to some professional investors to maybe even if you're putting in a buyout fund to private equity. But really understand who they are. You might go in and say, I have this great idea, and you look through the background, they just recently lost a bundle on that. Or they have a bias against that because it takes too much capital, or they have no experience in that area. So, and what are they really interested in? You know, are they really focused on retail? Or is it really interested in software? Are they interested in clean tech? You know, what are their interests? What are their likely concerns? So I always read through the bio. You get on the internet, read on the bio, talk to people, try to understand them before you send in your pitch to them, your executive summary. And be very cautious about items that you might think, gee, they've lost money in this area before, and you're coming in for the next time. You're probably wasting everyone's time. Let's see. Linda?
Here, come here.
Here we go.
I can be the clicker.
There we are. All right, so let's think through what elements do you really, really need in this plan. The number one thing is this executive summary. And that really should be a page, page and a half, which really summarizes, here's the opportunity. This is something about the size of the market, why we're going to be successful, why we have some really unique value we're adding there, who's the team that's doing this, what's the order of magnitude of the money you're looking for. So and that should really be well-written, carefully done. Then from a reviewer, what they're going to look at is the opportunity in some detail. And the opportunity, what they're going to look at is what's the market like? Is this a small market or a large market? What are the trends in the market? What are the underlying trends that occur in the market? Do you have a unique product service offering, or is it just like other product service offerings in that market? What is your business model? And the business model should be really focused on as much how you're going to acquire customers. And it's really, you know, what's your unique way of acquiring customers? Or do you have a unique way to compete against a competitor from your business model side? And
We've got your handouts we're going to hand out afterwards.
Yes.
Give people scribbing for your
Yes.
so just so folks know.
And an area that, at least when I look through business plans, I say, how much research have they really done? Have they actually gone out and showed a prototype with some customers? What are your research results? Is it just internet related, or have they actually gone out and tested this in the marketplace to get some feedback? They might end the research results. They said, here's a prospective customer that might be willing to buy the product or service. So illustrating you've done real work from a research side is very important. After you get a sense of the size of the market, the growth trends in the market, your product service offering, that's all kind of in your discussion of the opportunity. Next thing is who's going to do the work. And probably the most important, probably equal importance is who's the team. And, you know, what are the skill sets you're bringing to it? What's your experience base? Why are you passionate about this activity? Is this just something you have an interest in, or you're really passionate about it? Because most ventures, you're going to be in it for a period of time, and there'll be problems, and they know you're passionate about this. You have the right team members, or you've identified you need a team member that might have, for example, certain design skills, or might have certain marketing capability, or might have certain technical skills. That you've identified that. And back again, how are you going to market and sell this? Another area, and I can give so many examples, is the competition. And I can just give you a recent example in class. I had a student team came to me, and first I thought there was no market. And then they came and they said, but there's competition. And I said, that's the best news I've seen, because you actually have a market. So make sure that you've identified who your competitors are right now, who might be your competitors. And if you don't identify competitors, usually the assumption is you're naive about the business. So you bring forward the competitive issue, not only now, but who might the potential competitors be. And then you have in the plan, and I'm going to go back and do this a little more in detail, then you have in the plan as much about how you're going to go forward and operate this from manufacturing, operational stage, what are the real issues. But the investor, what they're going through their mind is first, is there a real opportunity here? And is this the team that can deliver? And if you miss on one of those two issues, it'll probably be a very polite but short conversation. And then they'll want to look at your financial projections, and it's really none of these financial projections will actually turn out this way. But the idea is, what's your rationale behind that? What are your key assumptions? And what you're looking from an investor side is you're really giving good thought to this. This business is similar to this business, and therefore we think in the long run it'll have these kind of margins, and here's the rationale for that. And as we build out the sales forecast, here's the real issue. Probably the largest degree of sensitivity in your financials is predicting revenue. You'll probably have the most swing on basically your revenue forecast. Your costs, you have so many people on board, you have to buy certain things, you can really get that down. But the revenue forecast is really where you'll have the largest degree of uncertainty. And then the investment considerations. How much money do you need now? What might you need a year or two from now? What will you accomplish with that? And the mindset you should have about in the investment area is the investor is looking at risk. And so with this amount of money, we put it in, we can prove that our product works. We can prove that we can get our first customer. With the next amount, we can prove our sales force actually works. And we can prove we can actually go from this one customer to several customers. With this next sum, we can actually ramp the sales force further, and we can prove that we're profitable. So think of this as a risk reduction area. So you're going through what are the risks you're taking out. So the investor is actually, what they're doing is they're looking at those risks and how those risks really interpret back to how much equity they want to take that risk. And then your risk and how you mitigate those. So if you look at a plan real quickly, you'll say, all right, I look at the executive summary, I look at the team, the opportunity, they have nothing about competition. Well, that's a real issue. They haven't thought about risk, there's real issues. Their financing plan does not really address how they're really going to acquire customers. Then you start to question the quality of the team, the quality of that investment. So those are just kind of, so what you'll really be preparing in the future is first this overview executive summary that try to encapsulate that. Then you'll have a slideshow which would probably be 10, 15 slides. And I would really recommend, have they talked about Jerry Weissman's book?
No, but again, there was a chapter on reading.
Yeah, I'd encourage you to read Jerry Weissman's book on basically how to give a good pitch. He's got some very, very good techniques. And Jerry is actually, here in the Valley, most CEOs which are going out to raise, for example, an IPO, go through Jerry's class. We bring Jerry into class. I think some of you have seen Jerry. I'd really recommend you. He's got certain techniques that just how to present. So I'd encourage you to look through that as you prepare to make your pitch. And then you'll be backing that up with this written document. And you'll probably have in your discussion with your investor, they'll be starting to ask a set of questions. And I at least find there's nothing more powerful at the end. You say, here it is, and all the questions you've answered, we have most of them here in this written plan if you'd like to read it. They might not want to read it. But what that really shows is you've given this thought, you've got the team behind it, you really have the thought behind it, you've thought about this in great detail rather than just having only the slideshow. You need the slideshow to get there. You might need this to close it. And there's some cases you might not. I invest myself. I won't invest in anything unless someone's done that, because I just realized they've gone through that thought process. So but others may or may not. We'll give it a try here, Linda.
Got it,
Already did it. All right. All right. So let's go back to the executive summary. Make it short and compelling. And really, this is your real entree. And usually the way that would work is you might have a colleague or someone that say, would you forward this? And what really happens is the ideal way to be introduced is someone who's actually been successful with that investor. And they'll say, gee, Pete, I know Pete, he's been in my class, and I really trust him, and basically, and this is a successful investor, a successful entrepreneur, and they would say, oh yeah, I'd like to have a meeting. Would you send the executive summary? And then, and that they'll read that quickly and say, then let's have a meeting, let's go forward with the meeting. So it's make it sure. You have a wonderful advantage here at Stanford in that you have a large network. Take advantage of that, but really look into the backgrounds of the investors. And you have if I look through your projects here in the class, you have retail, you have some in clean tech, you have a whole spectrum. And there's only certain investors that are really interested in certain subject areas. Be able to explain the business in 1 or 2 sentences so you capture them right up front. This is an exciting business. We're into this market. We have this unique product. We've got a team that can really deliver. We've delivered in the past, and here's the kind of returns you might expect.
I got it.
All right, good. So really focus, is there a really need, or is this a nice-to-have thing? So, if I look through the ventures I've been involved in, those that have it's kind of nice to have, they're really hard. And those that you have a really compelling need, it just drives everything. So really ask the question, is there a really compelling need for your product or service? And question that yourself and do field work on that. I mean, one of the best ways to test that, if you have an early prototype and you're out to a prospective customer and they say, if you can build that for me or you can do that, I'll buy it. Or maybe I'll even help finance that. I need it so much. I mean, then you've got the sense that there's a compelling need. I encourage you to look for big markets. There's as much work to do work in a small market as a big market. So, it's much more exciting. And the other issue is if you're in a larger market, you'll probably morph. You'll be in there and you'll go like this. So I'd encourage you to look at larger markets than small markets and realize that probably when you're in there, it'll change. And that if you're in a larger market opportunity, you'll actually morph or change. Encourage you also to think about pricing. At what price is this a really valuable service or product? And you should really have built yourself a very simple economic model that you really understand the economics of this business. We always have a series of student teams when they go through this exercise and then they get in the real cost of sales and they're not viable. So, and we can't move the price up more because there's competitive pressure. Make sure that when you present your forecast on the profitability that you don't have outrageous, that your margins have some reasonableness to it. Very often from student teams we have margins, and then I asked the student, I don't know of a legal business that has these margins. So, so just make sure there's some reasonableness to it. And then, why will you be successful? And part of the reasons you can say, I've already been in this kind of business, I've done this before, I have a team, I made a lot of mistakes before in this area, and I know what those mistakes are, and I've got some advisors to help me, and look at my market research, and look at how the market is taking off, and these are the trends. Have that compelling reason, because they say, is this a good business? Eventually there's a judgment call, and you need to make sure they're convinced that there's a real opportunity here. And proof that and the team is really, if you've got this incredible team, like that I know these team members, I've worked with them, there's no issue, we've worked before together, or we've known each other for a long period of time, we know we can work effectively. That's much more compelling than I'm alone, and I think I have to recruit someone in. I'm not sure whether that'll work. And if we do that, and one a real big cost in a company is if you hire someone, they don't work out. You're now 6 months, a year, 2 years later, still searching, and the risk is very high. Please stop me if there's any questions here. All right, don't even. All right. So, again, just the market size and growth trends, and try to be involved in areas where there's some really fundamental change going on. I love fundamental changes. For example, there might be in the internet space, all this social networking. That's growing that opens up all kinds of opportunity. Or it might be in the international area. You might have, for example, we've had student teams look at opportunities in China, where you get, or demographic changes, or there's some technological change going on. Those are really wonderful to ride. And that can be part of the compelling reason you go to an investor, you say, these trends are occurring. And I might not be successful initially, but we're riding that trend, and we can morph and move into a market area that is really attractive and profitable. Make sure you address really, and this, what the real issue in terms of the customer issues, that you've actually done field work and you've actually shown that this is a real interest. It might be something of interest to you, but it might not be interest to a large set of customers, that you've done field work, and this is a real pain point, or this is really adds significant value. So really address those issues in terms of, all right. If there's one thing I look for is really, what is your compelling value proposition? Why is this a great offer? And it might be a combination of price and service and others, but why is this really a wonderful offer to a customer? Why is it just kind of a me too? This, you really thought through what the proposition is to a customer. It might be an economic proposition, it might be a social proposition, but it's really compelling. It's not just minorly compelling. And if you can't answer that, go back and recycle. If I look at ventures I've been involved in and successful, and I say, when I can't answer this compelling issue, then the chance of success is much less. You then always morphing till you get to the point that you say, this is really, really compelling. And I can give numerous examples where it's been compelling and where it's been just marginal. And the marginal ones make it very difficult for you to be successful in the long run. Again, show your market research results. If you're going to an investor and you say, we've been out and we've talked to the following customer, or we've had this website up and we've had 1 million hits on this and there's interest over here, that's very different than say, we think there's something going on here. So I encourage you really to do significant amount of market research, prototype your products, and make sure you have a sense on that. And you can fail quickly on that. You can go in and look at, that's not working, we can do something else. And so I really encourage you to have that and have that ready when you, and feel comfortable yourself. You have to not only feel comfortable yourself, but as a team you have to feel comfortable. So make sure you have that comfort level yourselves.
A quick question.
Yes?
What are good ways that you've seen market research given in a presentation? Is it quotations, videos?
No, what I like to see in market research, I'll give various examples. Let's say, look at these customers. We've been out talking to them. Here's a letter that they're willing to buy this if we can be successful. I mean, but I'd like to see there's basic market research you can buy, you can see on the internet. Those statistics, that's kind of the early work. The other is actually out testing my product or service, even a prototype. I've shown this to a customer and there's real interest. Here's a little video of that. You can call someone up. I'd like to see really touching potential customers.
And someone asked this question in a different session, sort of, but if I'm showing you effectively my baby, you're not going to tell me probably that it's ugly.
Yeah.
So what are good ways to go out and get real feedback?
Yeah, go out and show them, and if they tell you it's ugly, it's okay. Because now you've learned that it's ugly, and you can change and come back and try again. And make sure you maintain relationship with that person or potential customer, and they say, oh yeah, and they get more engaged in that process. Yes.
Just to follow up with that, I mean, I think what you really need to do is you need to diffuse it at the very beginning. Like, giving me your honest feedback helps us improve the product. So that's really valuable.
Yeah, absolutely. You want their honest feedback. Like, I just had a student in class who said, well, I said, I know the president of this one company. She said, oh, he really dumped all over it, but he told me this is what we really need. I said, well, that's wonderful. Now you know what you really need.
Just to add to that, Michael Deering, we're having next talk about this. You might talk more about it, but I know in the IT school here, they do a lot of like make the ugliest prototype possible because people are willing to, so like even if you're starting with literally this paper and pencil and you're drawing it out, whatever, you know what you're doing, or you're taping stuff together with like, duct tape, as your cheapest prototypes, people will give you feedback and say that's ugly. If you have this perfect thing that looks really beautiful, people are more hesitant to criticize it.
Yeah, that's. I mean, you'll hear that design approach really works, and all of a sudden you'll get someone excited. I can describe. Several years ago, I started a company in the foreign exchange trading area, and we showed them. They said, "That's not what we want, but we want this." And the head trader said, "If you can build that, we'll buy it." And it was, well, that's just the information we wanted. We thought it was over here, but this is what we wanted. Or, there's always those kind of cases come about.
Sorry, Dennis.
All right. There we go. All right. So investors betting on you. Just realize that's the real bet. And so because if you're not successful, they're not going to be successful. And they're not only betting on you and your team members. So I look at the opportunity then the team. And if the team is right, then and they're really committed, and you sense of that commitment, and you need to, a part of your business plan is to flush out the commitment. What do you really measure as success? I actually coach some teams. I invest, but more as a coach. And I say, you got to tell me what you really believe is success as a team, and what your real weaknesses are, and whom we have to recruit in to be really successful. So what roles will they play? I mean, maybe there's someone early, someone wants to be the CEO, but maybe someone really feels, I don't want to do that. I want to be the chief technical officer. Or my strength is really in marketing and sales, and that's what I love doing. So make sure and say, in this business, we need absolutely incredible selling capability. So we can't be successful unless we really get the star salesman. Or we can't be successful unless we have someone who has really good design capability designing a consumer product. So just really think about that. You're fortunate if you're in this valley area. There's many people that love to be advisors to companies, and they really want to see you succeed. So, and they might be able to bring some very interesting skill sets. It might be in the science area. Gee, we really need some scientists who really understand this issue well. You can bring them on as advisors, and they'll be very happy to be advisors. This is thrilling for them to see you succeed, and it builds strength in terms of your offering to the investor group. A really compelling issue is, has this team worked together before? Because if they've worked together before, one of the large risks you have from an investor side is the team looks great on paper, but it's not going to really function because they have never worked together or they don't share common goals. And as I know from my own personal experience, if you lose a key person, then it takes maybe 6 months, 9 months, a year before you recapture that skill set. That's very detrimental. So make sure as you get your team together, ideally you've had some experience working together. And maybe it might be at least putting together the business plan, and ideally they've worked in maybe a similar capacity. Maybe you've been to the GSB together, you've worked on, but try to flesh that out. Ideally they've been in a similar company and you've come together. But that is a very... and then make sure you've thought through leadership and decisions. You know, who's the leader of the principal leader? Because an investor wants to know, who's the leader, who do I talk to? And maybe the leadership might be, there's a leader overall, but there's really critical skill. We have this chief sales officer, the VP of sales is also really critical. And then we have someone over on the technical side, or we have someone is doing design work, or whatever the real needs are of that company. So make sure you've thought that out and have that, during your presentation, you'll be subtly asked questions around that. And they'll question you then, and they can understand, a good investor can understand some of the dynamics around that. So you've got the opportunity and the team. All right, competition. And there's several exercises. There's known competition today, and I can relate stories from my own experience. I thought there's no other competition. And you go out, and one is in the computer security software company. We thought we had the leading software. We went to a show, and out of Israel came a competitor. So think of known competitors and who might also compete against you. And a good drill you can do as a team is say, we've launched our new product or service. Now, who is going to compete against us that we're in this business? And how will they destroy us? And go through that drill. How will they try to bankrupt us? Will they offer a lower priced product? And think about that. So when the question comes out, you say, this is how we would compete against that kind of situation. Because a good investor will have that in the back of their mind. You say, well, have you thought about so-and-so and you might not have thought about that, and how are you going to compete against them? And there's real advantages you have as a small company, but also just think about some major, large company might decide to get in your area, and they can throw incredible resources against you, and how do you compete against them? So just make sure you have a good section on competition. It increases your credibility immensely. All right. So then as you lay out your plan, one way to think about this is, we're starting up, and maybe we need to build a little prototype product. And maybe we have to really test this out in the marketplace. And when we've done that, we've shown our product is really valuable, our service is really valuable, and we've shown real customers will buy it. We're maybe not profitable at that point, but what you've done from an investor side, that's a staging. That's an early stage. You've proven that out. How much capital do you need to do that? Now, an investor will feel much more comfortable. I can do that, and now at that point, now you'd like to kind of grow the sales more. well, we've got one salesman on board, but we need to have more salespeople, or we need to increase, we've got this working on Facebook, and we want to make it work on Twitter also. And how do we get it on both of these? And we've got a little experiment going, and we can now maybe double our sales or triple our sales. And you say, now we've proven out our customer acquisition model, and we need capital to prove that out. So you start to lay this out in stages, how much capital you need initially, how much capital you need the next stage, and then we need this amount of capital to really get to a break-even point, at least from a cash flow side, and we can show some upside. So you usually have some staging of capital, and what that implies is the early capital is going to be more expensive because you have all these risks. But if you can get that risk out, then the next stage you can get much better terms. So you're basically driving risk out and improving your terms. Then think from, this again goes back to who is your investor. Now, some of you I can see in the class are going to be involved with private investors that really just love cash flow. And there's nothing wrong with that. I've been in one investment that we had 20 years, and every month I got a check. And that's very nice. And so, and it might not be the one that you can, but it's got a very nice cash flow. So think, is the investor really interested in cash flow? Is that important to it? And that's probably very true of some private investors. They participate, they really enjoy you, they trust you, they're going to, and eventually they might own 20 or 30%, and that throws off cash. And they have the fun of working with you. Others are going to say we have to keep investing over time, and our big gamble is that you can sell this company to so-and-so. You can sell it to P&G, or you can sell it off to Cisco, or you can sell it over here. So think, from a liquidity side, there can be a cash flow liquidity issue, or there can be liquidity on a potential sale. And if you're not really interested in providing liquidity to an investor, then that's probably not the right investor. And probably you really have to think that through. So you have to think from their perspective, when do they have liquidity? And some of them don't need the liquidity immediately. They might want, we'll gamble with you for 5 years and then we'll play. And others say, this is a family foundation. We're expecting to get small amounts of money each year over time. We can invest with you, but there's a different perspective. So liquidity. And then think through your offering. And this is really, there's two different perspectives. The professional investors like to say, here's the terms. But I like to have thought through what terms I'm willing to accept. And what you can think through is what are prospective returns that they would get, so that opens in some of the negotiation. And you can expect early investors maybe want, if it's 10 times their money, but later on it might be 3 to 5 times. Maybe later on further it might be 2 times their money. So and you can kind of understand where they're at, and you can say, that's outrageous, really. You've got an upside of, you're talking about a larger upside here than that. And then what the investor will usually always want in their perspective is they'll say, we want ways to protect ourselves that the event this doesn't really turn out as well as we've thought about. And usually that is through a preferred offering, which basically said, we get our money back before you get any money. So if we're putting in $1 million before you receive any money, we get our $1 million back, and we get some kind of pro rata share thereafter. So expect they'll probably have those in some kind of term sheet of that sort. And it might also be, the other thing they're probably really concerned about is, are you going to be around? We put our money in, you decide, well, there's a much more interesting opportunity over here, and I'd rather go someplace else. So there'll be terms to really restrain you from competing against the company they've already invested in. So they'll want some competition things. They'll want probably that even though you have the majority ownership, there's some vesting of those shares over time, so they have the right to buy those shares back if you decide to not to participate going forward. So there'll be in any negotiated agreement, there's going to be terms that that attempt to, at least from a financial side, protect the investor and keep alignment of goals, your goals and their goals aligned. Yes?
When you talk about potential returns, I presume you're talking about sort of through the course of the investment.
The course of investment, yes, Fraser.
Does that then mean that you have to predict, or in this plan, discuss how much further money you're proposing to take, and what type of pre-money evaluation, how much dilution is going on? So
Right. Well, I think the way I like to do this, you do that. You don't necessarily show them what you expected, but you have a sense that, gee, in the long run, our company is going to look like such and such. And it might have, and here's a potential acquisition candidate, or it could be grandly successful as an IPO. And here's probably, and this is the reason why it looks like such and such.
And this is how much of it you'll own
at that time, yeah. Well, you have an indication, and part of that is then the negotiation. They'll come back and they'll say, here's the pre-money, and you say, well, that seems a little outrageous. Right, and because if you did that and you look through the arithmetic, you're really earning 50 times your money, and typical, and you say, I have other, and this is what I've learned is the norm. So it's really as much for your negotiation, but you need to show the capital you need over time. So if you go into, for example, an angel investor, maybe their maximum they would put in a deal might be $500,000. I'm just saying. And you need $3 million. So they'll say, I can maybe help you find a professional investor, but I'm really early stage, and I'll help you find that. But if they can't help you find, you might be in a difficult situation. Does that help you?
Yes.
Yeah. Any other questions?
Just a real quick one. You mentioned that there's some asset classes that just throw off cash.
Yeah.
So I was wondering what kind of deals are structured. Like, are you talking like a debt instrument, or are you talking
Well,
about?
I'll describe one that I was involved in, right? So this was a former GSB, and we decided to start up a business, and he was fairly wealthy, and he liked the idea. And so he said, I'll fund you, and was actually set up as a partnership.
Okay.
And it was the S Corporation partnership, and he said the way it was structured, but we paid his money back, and once we paid his money back, then we split the pie so-and-so going forward.
So you're basically issuing a dividend?
Yeah, just dividend out. But until we dividended out and paid his position back, none of the other members, and that's not untypical of that kind of deal. So you basically dividend out, and you structured, usually at that case, some of the issues, he was a wealthy individual, so we structured it so that it was tax advantageous to him. So when we were getting the company going, all the tax benefits flowed to him, and so you can do some structuring from that side. Yes?
When you're building a financial model,
Yeah.
how aggressive do you recommend going? Because on one side, I can see wanting to get aggressive and saying this is great potential, but on the other side, if you're going to be held to it,
Yeah.
there is a side of maybe slightly underplaying, so you're always kind of the rosy child.
I like to kind of slightly underplay, but in the selling to them, say, but the upside is here. And then use that as part of the negotiation for the equity position.
Yeah.
Yeah, because, and the reality is I've done 7 successful companies, not one of them followed the plan. But it was part of the negotiation there, and you actually find, maybe you're in it 6 months and you say, gee, we have to redirect in a certain way. Yeah. Any other kind of questions along those lines? So I'd encourage you, as you lay this out, try to think of comparables, try to think of the kind of investor you're looking at, and some of them cash flow is a lot of the smaller investors, they just look for a cash generating company, and it's fun to work with that person. And they really fun to work with that team. Like there's one gentleman, we worked together for 20 years, we enjoyed going to board meetings, and there was younger people running the company, and it was fine. All right. So these are the big risk area, really. And you'll both address these in your stage-wise development, the market and product. Do you have a real market? Do you have a real product? What are the risks from that side? An area that always comes up is how are you going to acquire customers? Are you using the internet to really acquire customers? Have you really thought through that? How are you going to prove out that you've got a really good customer acquisition model? So make sure you have thought that through. And what if that model doesn't work? What alternatives do you have? You have this great product, but I can't really get it out to customers. Do I have an inappropriate marketing approach? Have I not got enough marketing going on? Do I have to spend more marketing dollars? I can relate one time, which I was very frightful about, and we weren't quite getting traction, and the investor said, let's start throwing $2 million a month in marketing dollars. And I'm looking at this as crazy. But they said, we'll back you because we believe you've got enough market research to prove that. And they were right, but I was very, very frightened. I mean, just seeing this sum of money being placed, each money for ads and going out to try to get the market awareness. So really think about the marketing area. From a technical side, try to ask this kind of question. Really look at where the real technical risk is, not whether you can build it, but what really has to go right. And sometimes when you look through a product, there's just this one thing. If we can really get this one piece right, then the other pieces are doable. But we have to really address that technical risk first. And this happens very often as science-type related activity, or it might be a regulatory thing. We have to get through the government FDA test. And if we get through that, we're okay. Or if this bit of science really works, we've got a home run. And we have to get patents on that area. But one caution is, as you work with the technical team, they might want to work on all aspects, and you have to focus on what the real technical risks are. So focus on where the technical risks are. So you'll have, and I'd like to see a section in your report saying, here are some of the risks, and this is, if this goes wrong, this is how we think we can mitigate that risk. So or there might be an issue, for example, we're out there in the marketplace, and we're fairly disruptive in the marketplace, and a major competitor might come in, and here's how the way we might not be able to compete, but they might see we're ahead of the market by 2 years, and they'll buy us. And the way we're going to mitigate that, we're going to have on our board of directors someone from what we think might be one of the competitive companies, and they'll let us know, and we make a deal. So you just think about other kind of risks, or one of the scarier risks is sometimes government risk. You know, what can happen is there might be a regulatory change. And we're really betting on this, and that happens, then what do we do? So just think about, place the investor's situation, you know, what could go wrong, and what they're looking for you is as much your thought and your thinking about the risk elements. And have you thought about that? And if I look through a plan and I don't see a direction on looking at risk, then no competitor analysis, no risk analysis, and some fancy financial numbers, it's kind of, you lose some confidence. All right, so back to your plan. So you're going to have basically a really nice executive summary to get them in play, and then probably 10 to 15 slides that tell the story. And what the story is going to be as much as about you. And so you don't have a lot of details on the slides. They really want to see you. So the real issue is you and what's happening. Then your written plan really clearly, make sure you clearly define your business. This is our business. This is what we're offering. This is why we believe we can be successful. Back on the opportunity. Make sure you define the opportunity. And as I've mentioned before, I'm just so convinced on the value proposition. If you have a compelling value proposition, a great team, and a good market, you'll be successful. So acknowledge the competition and identify what can go wrong. And then be prepared to negotiate, gee, you're going to invest $500,000 here, you'll own 25% of us, here's the upside, and maybe in 5 years from now, that $500,000 it might be worth 7 or 8 times or 8 times that, but we could actually, if we were really successful, it could be worth 25 times, but our base case it's 5 times. And they'll say, and not only that, we have a product extension that we could really, we're in the U.S. market, but we could also enter the European markets or the Asian markets, and that could double or triple it. So now you've created a reasonable case and then some potential romance on the upside. And make sure it's clear and readable. And not a lot of jargon. Assume that the vocabulary level, there is a lot of jargon in there, just make it really clear and easy to read. So, again, your basic pitch, maybe 10 or 15 slides, be prepared to present for maybe 20 to 25 minutes, and then you'll be Q&A'd for another 20 to 25 minutes, and then a nice, clear written plan, which takes work. I mean, as a team, you'll have to go through that several times to get a really clean business plan behind that.
But Dennis, do you really think they will sit there while you go through your presentation?
No. Usually what will happen, you'll get in, you'll be in about 2 minutes, and they'll say, but tell me about the market. I remember seeing a competitor over there. Tell me about that. And they'll say, oh, you claim you have this background. Tell me about your background more. And a lot is just, you won't probably work your way through your slides, but you might say, well, I'd like to talk about this. And then you've got the backup information. Or I'd like to show you this market research we've done. And you say, look, this is a letter we have from a potential customer that wants to buy our product. And there'll probably be that kind of dialogue, most likely. And part of this, they'll look at your ability to manage as a potential leader. If you can manage that conversation and bring them back to where you'd like to drive it. I have some, so those are a winning plan. And then I have some information which we can hand out further, which basically, on the detail.
This is in the handouts that we have.
Handout, and you need to look at this is details in your written plan, and realize this is not, every plan is different. So these are kind of components, and you might emphasize one component more than another. For example, there might be issues related to sales and marketing might be really critical, the economics, but these are broad issues that we have as an outline. Maybe we could hand those out. I'd be glad to entertain any questions. Yes, Leila.
I had a question around when you said pitching, right at the beginning you also talked about pitching to key people and especially board members.
Yeah.
Can you talk a little bit about pitching to board members when you do want somebody as you're putting your
Yeah, so I described very early in my career and later on. So you might say, gee, if you know someone first is how you're introduced to the person. So the introduction is going to be really important. And then an astute board member will say, I'd like to meet with you and go through your presentation. And you have to say, well, this is really a wonderful opportunity over this area. I think you could add real value because I know your background. It might be, say, you're a scientific advisor. I've read about your background. You really know the chemistry in this area. And you could be an incredible advisor. Would you like to be on board? And then they'll say, well, I might have a conflict of interest. Or they might not have a conflict of interest. And they say, yeah, and I know you, Leila, well, or I've known of you, and they'll probably immediately do some reference checking on you. Because a significant board member, their big issue is also their reputation. So what they're adding is their reputation, and they'll say, can you give me some personal references? And so you probably say, well, yes, you can call so-and-so and so-and-so. So they do that. And then the next possible negotiation, they say, well, we'd like, what are you offering in terms of ownership? And it depends on how large the pie is, what the ownership typically is. And then you'd say, well, what are my responsibilities as a board member? And then they say, well, we'd like you to be a board member, or maybe we just want you to be a scientific advisor. As a board member, I now have responsibility for other shareholders. If a scientific advisor, I'm just really responsible for bringing in some expert knowledge to you. So think about the role and what role they could really play. And a good board member will say, well, I've got a conflict over here, or I really can't commit the time, and I want you to be successful, but I can commit the time. It sounds exciting. And does that help a little? Yeah. Any other questions? Yes.
One of the things we're facing when trying to do market research and really gauge viability is that the folks who would be most helpful to talk to, we think, could actually be companies that down the road would either want to acquire us or consider us competitors. So what sort of considerations should we have really early about kind of telling them where we are for the sake of also validating our thinking?
Well, let's say the potential acquirer. That's not all bad.
Yeah,
I mean, I can relate. I've done a fair amount in the computer security area. And early stage, I would try to get meetings with McAfee and others. And if I meet with them, we'd have kind of a discussion what we were doing, but we wouldn't say our proprietary algorithm, but we'd get feedback from them. And then I knew that if they were really interested and they were in that space and we got to a certain scale, might be an acquirer. So that's not all bad. And plus you're already getting back some competitive information. They say, well, we really don't want to talk to you because we've got an NDA, a non-disclosure agreement, and this would be, we just don't want to be in that situation. Well, that is giving you some very good competitive information that a competitor is there. Smaller organizations realize the biggest challenge is in execution. And so if you got, the idea has value, but the real value is in executing. So if you've got an incredible team that can execute well, you probably will win. So I know people are always cautious about that, and I find, at least my experience, most people are ethical. And you go out and they'll say, I don't want to talk to you because we're doing work in that area and we really don't want to do that. Or if you have something proprietary and they're sharing proprietary, then you usually sign some mutual NDA.
So
Yes.
it's appropriate to do market research, but not common practice in dealing with investors.
Yeah. And investors, and quality investors will, at least my experience has been, a quality investor will probably invest in your firm, but not in a competitive firm, because they've also got a reputation. And if their reputation is they don't act with integrity, this is at least I know this valley, this is a very small valley, and it would not help them at all. Plus, but I think it's just more of a personal integrity. Yeah. Yes.
One more question?
Yes, Jason.
So I know you, going back to the board member question,
Yeah.
I know you kind of said it depends on the size of the opportunity.
Yeah.
But is it possible, say it's a $50 million opportunity, what would you expect from a board member?
If 50 million final valuation,
Just for instance.
it depends on. Let's give you some counterbalance. Let's say you're a medical doctor, and this is a small potential drug into a small market, but you're really passionate about this outcome. This might help someone in Nigeria. It might be a specialized drug they're building. They're probably less motivated on the ownership side. It's more, this is really exciting. And it's something I'm passionate about. So I think you want to look for the passion on the person. If it's really, is this something really interesting to them? And it's got to have some merit to them in the long run, but I think that's the lower interest. if I look when I was a younger man and starting to come, I had 2 people, and they really were excited about what I was doing. And so we gave them a couple % here and there, but they actually coached me. And it was really, I feel very grateful to them. So it's really that kind of relationship, you know, are they getting rewards other than just monetary? If it's a $500 million thing, the negotiation will be different. Because then they'll probably want slightly more. And it's also their reputation at stake. His or she reputation is at stake. And will they like to go out and say, well, I'm involved in Jason's company, and they're doing this exciting area. It's not, and they're really adding some significant value, and they can talk to their friends about it. And why do some, like I'm a trustee, and I earn nothing about that, but I'm excited what's going on there. And I can realize I can, through my background, I can add significant value. So there, the upside is I donate. So, I mean, so there's really, so look for someone who's motivated and interested in your opportunity and believes they can add value. All right.
Thank you, Dennis. That's a lot to chew on. Thank you. We have enough time for a bio break and one lap around the building. We're going to start again at 3:15. Michael Deering is going to be here, and I think he's going to do a little work. So come back to 3:15.
I did my reading.